Gold hit a record $3,000 an ounce today, and X is blowing up about it.
Yeah.
It's kind of funny, right?
Hmm.
In the age of Tesla and AI, this ancient hunk of metal is suddenly front page news again. It's like we're all channeling our inner prospector.
It's definitely catching a lot of people off guard.
Yeah.
Gold seems like a relic of the past,
Uh-huh.
especially when the world is obsessed with things you can't even hold in your hand, like software data and AI.
Exactly. But that's what makes this whole thing so interesting, and we've got a book that's going to help us unpack it all.
Okay.
Capitalism Without Capital: The Rise of the Intangible Economy. I know the title sounds like a mouthful, but trust me, it's a fascinating read. Even Bill Gates recommends it.
Oh, wow.
Yeah.
It's a really insightful book.
Yeah.
Haskel and Westlake, the authors, they argue that we're living in an age where intangible assets, things like software data, intellectual property, are actually getting more valuable than the traditional tangible stuff. Factories, buildings, even gold mines.
So a brilliant algorithm is now worth more than a mountain of gold bars. That's a wild thought. But if that's true, why is everyone suddenly so obsessed with gold again?
But that's where things get really interesting. The book dives into this inherent uncertainty of this intangible economy. These assets, as valuable as they can be, are also incredibly volatile. They can be incredibly difficult to value, and their worth can evaporate overnight.
It's like investing in a hot new app. It could be the next TikTok, or it could just as easily end up as, well, remember that app that let you send virtual potatoes to your friends?
Precisely.
Yeah.
And that's where gold comes in.
Yeah.
It's the ultimate tangible asset. It's something people have understood and valued for thousands of years. And in times of uncertainty, that kind of stability is incredibly appealing.
So it's like a security blanket for investors.
Yeah.
When the tech world feels like a roller coaster, they reach for something solid, something that's always held its value.
Exactly. And we're seeing that play out in the markets right now. Gold is up 13% this year alone. And it's not just individual investors. Remember that JP Morgan report we saw last month? China just bought a massive chunk of gold, something like 15 tons, to add to their reserves. Central banks are getting in on the action.
So if everyone's piling into gold because of the uncertainty of the intangible economy, what exactly makes it so uncertain? I mean, tech is booming, AI is everywhere. It all feels pretty unstoppable, right?
That's the thing about the intangible economy. It's driven by innovation, which means it's constantly evolving, making it unpredictable. One of the key characteristics the book highlights is this idea of sunk costs. Investing in intangibles often requires a huge upfront investment, but their resale value can be incredibly low, especially compared to something like gold.
So you're saying there's a lot more risk involved.
Absolutely.
Yeah.
Let's say you pour millions into developing cutting-edge AI software. There's always the risk that a competitor beats you to market with a better product, or that the technology becomes obsolete faster than you expected.
Yeah, and then your fancy algorithm is basically worthless. But gold, you can always melt it down and make something else.
Exactly. It has intrinsic value that transcends market trends or technological advancements.
So in a way, it's almost like insurance for your portfolio.
That's a great way to think about it. And we're seeing more and more investors, even those heavily invested in tech, adding gold to their portfolios as a way to hedge against that uncertainty.
So what are some of the other characteristics of this intangible economy that are contributing to this gold rush? I mean, you mentioned sunk cost, but what else is making investors nervous?
Well, the book dives into a few other key points that are worth exploring. For example, the authors talk about scalability. It's one of the biggest advantages of intangible assets, but it also creates some unique challenges.
Okay, let's unpack that. What exactly do they mean by scalability?
Think about something like an AI algorithm. You can use it endlessly without it being used up like a physical product would be. That makes it incredibly valuable. But it also means that the companies who create the most effective algorithms can quickly dominate the market.
So it's like a winner-take-all scenario.
Exactly. Which makes investing in those companies risky. If they fail to stay ahead of the curve, their value can plummet.
It's like being at the top of the tech mountain. It's a great view, but one wrong step and you're tumbling down. Whereas gold is more like, well, solid ground.
A very apt analogy. And this brings us to another key characteristic: spillovers.
Spillovers. Okay, now I'm really intrigued.
Think about how quickly ideas can spread in the intangible economy. A software update can be shared globally in seconds. That's great for innovation, but it also means that the barriers to entry are lower, making it harder for companies to protect their intellectual property and maintain a competitive edge.
So it's a double-edged sword. You can get your product out there quickly, but so can everyone else.
Precisely. And that creates a lot of uncertainty for investors. It's difficult to predict which companies will be able to maintain their dominance in such a rapidly evolving landscape.
Which brings us right back to gold. It doesn't need software updates. It just sits there gleaming being gold.
And that, in today's world, is a surprisingly attractive quality.
This is all fascinating. We've got a lot more to unpack here, especially about how this all plays out for businesses in the real world. But before we jump into that, let's take a quick look at what Bill Gates has to say about this whole intangible economy thing. Okay, so we've got Bill Gates, the ultimate tech guy, recommending a book about the rise of the intangible economy. You know, the same guy who built an empire on software and the internet. What's his take on all of this?
Yeah, it's interesting, isn't it? On his blog, gatesnotes.com, he called the book eye-opening. And I think what really resonated with him is how the authors connect these big economic shifts to the world of technology, a world he obviously knows a thing or two about.
Right, it's like he's seen the future of the digital world and he's also saying, hey, don't forget about the old school stuff.
Exactly. And, while Gates is a tech giant, he's also deeply involved in global health and development initiatives. These are areas where stability and long-term thinking are paramount.
So maybe his interest in gold isn't so surprising after all. I mean, it makes sense if you're looking for something that holds its value over generations.
Absolutely. And his perspective seems to be resonating with a lot of people. Did you know he gets over 10,000 mentions on X every time he talks about the economy? People really pay attention to what he has to say.
That's a lot of people. And speaking of X, it's been exploding today, with news of gold hitting that $3,000 mark. Over 20,000 mentions last time I checked. It's not just some abstract economic theory, it's playing out in real time right in front of our eyes.
It's a perfect example of how these economic forces are impacting the world around us right now. And it's not just social media buzz. Central banks are making big moves too. Remember that JP Morgan report?
Yeah.
China added 15 tons of gold to their reserves just last month.
So it's not just individuals, but entire countries are betting on gold in this current climate. But hold on a second, we were talking about Bill Gates and his focus on stability. Is there a connection there?
There might be. Gates has talked a lot about the importance of building resilient systems, whether it's in healthcare, energy, or finance. And gold, with its historical track record of stability, could be seen as a way to add resilience to a portfolio, even a tech-heavy one.
So even if you're all in on the digital future, it might make sense to have a little bit of old school gold in your back pocket just in case.
It's a strategy more and more investors seem to be adopting, especially given the uncertainty of the intangible economy.
Okay, but how does this all play out for businesses? I mean, I get that individual investors might be buying gold, but are companies really factoring this into their strategies?
They are. And it's actually fascinating to see how some of those innovative, tech-driven companies are approaching this. Imagine a company like, say, a cutting-edge AI startup. They're developing algorithms, collecting data, building a business entirely in the intangible space.
Okay, I can picture that. Lots of lines of code supercomputers humming away, maybe a ping pong table in the break room.
Exactly. But here's where it gets interesting. This company, while fully committed to the intangible economy, might also decide to invest a portion of their assets in something tangible, something like gold.
So they're not putting all their eggs in the digital basket.
Exactly. They're acknowledging the inherent volatility of the intangible economy, especially in a year like 2025, where the future feels anything but predictable.
What are some of the challenges businesses face when trying to balance these tangible and intangible investments?
Well, for one thing, it requires a shift in thinking. For a long time, business strategy was all about physical assets, factories, supply chains, that sort of thing. But now you have to consider the value of things like data, intellectual property, and brand recognition.
It's like comparing apples and oranges. How do you even begin to measure the value of something like brand recognition against the price of gold?
That's a challenge a lot of businesses are grappling with right now. There are no easy answers. And it's further complicated by the fact that the value of intangible assets can change so rapidly.
So you could invest millions in building a brand, and then a single viral tweet could completely destroy it overnight.
Exactly. And that's the kind of risk that keeps CEOs up at night. It's why we're seeing more and more companies, even those deeply rooted in the tech world, hedging their bets with investments in tangible assets like gold.
It's like an insurance policy for the digital age.
That's a great way to put it.
Yeah.
And it's not just gold. We're seeing companies invest in real estate, fine art, even rare collectibles, as a way to diversify their portfolios and create a buffer against the volatility of the intangible economy.
So it's not just about gold then, it's about finding tangible assets that hold their value over time.
Precisely. It's about creating a balanced portfolio that can weather the storms of an increasingly unpredictable economic landscape.
This is a fascinating discussion. We've talked about how individual investors are reacting to this intangible economy, and now we're seeing how businesses are adapting their strategies. But what about the impact on the markets themselves? I mean, with all this uncertainty and volatility, is there any way to predict what's going to happen next?
That's the million-dollar question, isn't it? And it's one that even the brightest minds in finance are struggling to answer. But there are some tools and models that analysts are using to try to make sense of it all.
Oh, like what?
Well, you might have heard of something called Fibonacci projections.
Fibonacci projections? That sounds awfully complicated, like something out of a science fiction movie.
It might sound complex, but it's actually a fairly simple concept.
Hmm.
It's based on a mathematical sequence that some analysts believe can be used to predict market trends.
Okay, break it down for me. How exactly do these Fibonacci projections work, and what are they telling us about the future of gold?
Essentially, the Fibonacci sequence is a series of numbers, where each number is the sum of the two preceding ones. It starts with 0 and 1, and then goes 1, 2, 3, 5, 8, 13, and so on.
Okay, I'm following so far. But how does the sequence of numbers predict the price of gold?
Some analysts believe that these numbers, when applied to financial markets, can help identify key support and resistance levels. They look for patterns in the price movements of an asset like gold, and then use the Fibonacci ratios to predict where the price might go next.
So you're telling me these numbers discovered centuries ago can help us understand what's going to happen in the modern financial market?
It might sound strange, but there's a growing number of analysts who believe that Fibonacci projections can provide valuable insights into market trends. And based on these projections, some analysts believe that gold could continue to rise in value, potentially hitting $3,254 or even higher.
Wow. So we've got social media buzzing, central banks buying, and now these mathematical projections pointing toward a continued rise in gold prices. It's like all signs are pointing in the same direction. But isn't it a bit risky to rely on a mathematical sequence to predict the future?
There's always risk involved in any kind of market prediction. But Fibonacci projections, when used in conjunction with other forms of analysis, can provide a valuable tool for understanding market trends and identifying potential buying and selling opportunities.
So even in the age of AI and supercomputers, sometimes it's the old school tools that can provide the most valuable insights.
It seems that way. And it's a reminder that even in the rapidly evolving world of finance, some things never go out of style.
This is all so fascinating. We've covered a lot of ground today, from the rise of the intangible economy to the resurgence of gold as a safe haven asset. We've explored the challenges businesses face in balancing tangible and intangible investments, and we've even delved into the world of Fibonacci projections and market predictions. But I think what's really struck me is how interconnected all of these seemingly disparate ideas are.
I agree. And it highlights the importance of having a holistic understanding of the economic landscape. We can't just focus on the latest tech trends or market fluctuations. We need to consider the broader context, the historical forces at play, and the interplay between the tangible and intangible worlds.
Right. Because as we've seen today, even in the digital age, sometimes it's the things you can hold in your hand that hold the most value.
Yeah, it's like we're living in this strange paradox where the future is more uncertain than ever, but the past is offering us a sense of security.
Yeah, and it's funny, we were talking about this before the show, but I was reading this article about how Gen Z is actually really into collecting vinyl records.
Oh, wow.
Like they're rediscovering this old technology and finding something really tangible and authentic about it.
Yeah, I think it speaks to this desire for something real, something you can hold in your hand in a world that's increasingly virtual.
Hmm.
It's like a counterbalance to all the digital noise.
It is, and I think it ties in perfectly with what we're talking about today with gold, right? It's this ancient asset that's suddenly back in the spotlight because it offers a sense of permanence and stability in a world that feels anything but permanent or stable.
Exactly. And it's not just about nostalgia or a rejection of technology. It's about recognizing the value of both the tangible and the intangible. Finding that sweet spot where the two can coexist and complement each other.
So it's like we're not saying ditch your smartphones and go live in a cave.
Right, exactly. It's about balance and finding what works for you.
That's a great point. So if we had to distill all of this down to one key takeaway for our listeners, what would it be? What's the big aha moment they should walk away with?
I think the biggest takeaway is this. As the intangible economy continues to grow, the role of tangible assets like gold will likely continue to evolve in unexpected ways. It's not a simple case of old versus new or tangible versus intangible. It's about understanding the interplay between these forces and finding the right balance for your own investment strategy.
And that balance might look different for everyone, right? It's not a one-size-fits-all approach.
Exactly. It depends on your individual risk tolerance, your investment goals, and your overall financial situation. But the key is to be aware of these trends and to make informed decisions. Don't just follow the herd or chase the latest fad. Do your own research, understand the risks, and find a balance that works for you.
Speaking of research, it's really interesting. We've talked a lot about how individual investors and big institutions like central banks are buying up gold. But even the world of AI is getting in on the action.
Yeah.
Bloomberg reported that AI algorithms have actually improved gold price prediction accuracy by 15%.
Mm.
It seems even gold, this ancient tangible asset, is being influenced by the rise of AI.
This full circle moment, right?
Yeah.
We're using the most advanced technology to analyze this ancient form of investment. It's a reminder that everything is connected in some way.
It is. And it makes you wonder what other surprises are in store for us as the intangible economy continues to unfold. I mean, if AI can predict gold prices, what else is it capable of?
It's an exciting and slightly unnerving thought, isn't it? But I think it just underscores the importance of staying informed and adaptable. Being open to new ideas and new ways of thinking about the world.
So as we wrap up this deep dive into the world of gold and the intangible economy, what's the one thing you'd like our listeners to remember?
I think the most important thing to remember is that we're all navigating this new economic landscape together. There's no roadmap, no guaranteed path to success. But by staying curious, learning from each other, and embracing both the tangible and the intangible, we can find our way forward.
Couldn't have said it better myself. And on that note, we'd like to thank you for joining us on this fascinating journey into the world of gold, the intangible economy, and everything in between. We hope you found it insightful and thought-provoking. And as always, we encourage you to continue exploring these ideas and to share your thoughts with us on social media. We're always eager to hear from you.
Thanks for having me.
And until next time, happy investing.